All right, here's a simple example that demonstrates how spot trading and derivatives trading can work in practice. So generally, there are two possible cases. Either we can expect rising prices or we can expect falling prices. And first of all, let's have a look at rising prices. So we have the traders A and B, and they expect the price of Bitcoin to rise in the near future, so relative to the US dollar. And the current Bitcoin price is, for example, 40,000. Then to benefit from rising prices, Trader A does the following. So Trader A is a spot trader, and he buys, for example, one Bitcoin for 40,000 US dollars in the market. And then 5 days later, the Bitcoin price has increased to 45,000. And then Trader A decides to sell the Bitcoin and to realize the profit. So a profit of 5,000 US dollar. And to sum up, so he realizes a profit of 5,000 with an initial investment of 40,000. So that's pretty great, but let's compare this to the derivative trader. So trader B is a derivatives trader, and he bets also on rising Bitcoin prices with a long contract in the Bitcoin worth 1 Bitcoin. So if a trader expects rising Bitcoin prices, then he should go long the Bitcoin. And if he expects falling prices, then he should take a short contract, so long and short. And now let's assume that the margin requirement is 50%. And in our case, this means 50% of 40,000 is 20,000. And the trader has to post a margin of 20,000 to the broker. And if the price moves into the wrong direction, so in our case, if the price falls, then the margin of 20,000 serves as a collateral for the broker. So the broker requires a collateral. But in our case here, the price doesn't fall. So after 5 days, we are at 45,000. And trader B decides to terminate or to close the contract. And by doing so, he realizes a profit of approximately 5,000. So he gets a compensation from the broker, a cash compensation of 5,000 approximately. And I've written here approximately because depending on the derivative, it's not necessarily exactly the price difference between 40,000 and 45,000. So approximately 5,000. And he actually realizes 5,000, the profit 5,000 with an initial investment of only 20,000. And we can conclude here that the profitability or the return of trader B is twice as much as trader A. So trader A invested 40,000 and the trader B only 20,000 to generate a profit of 5,000. And this is the impact of leverage. So we have here a margin requirement of 50%, and this is equivalent to a leverage of 2, so 2 to 1. All right, this was rising prices. And now let's move on with the expectation of falling prices. So now traders A and B expect the price of the Bitcoin to fall in the near future. And again, the current price is 40,000. And now let's have a look how the spot trader can benefit from falling prices. And typically, spot traders can't directly benefit from falling prices. But yes, if a spot trader already owns the asset, he or she can sell the asset to avoid losses if the price goes down. But a spot trader can't generate direct profits with falling prices. And if the spot trader doesn't own the asset, then he or she can't benefit at all from falling prices. So that's the theory, but later in this course I will demonstrate a blended strategy that allows also spot traders to actually benefit from falling prices. So we will see this later in the course. But now let's move on with the derivatives trader. And Trader B bets on falling Bitcoin prices with a short contract worth 1 Bitcoin. So to say, he shorts the Bitcoin. And also here the margin requirement is 50%. So he posts a margin of 20,000 to the broker. And 5 days later, the Bitcoin price slipped to 35,000. And then Trader B terminates or closes the contract, and he realizes a profit of approximately 5,000 with an initial investment of 20,000. So this was a simple example how spot trading and derivative trading works in practice. And now let's conclude. So we have spot trading and derivatives trading. And typically spot traders can only benefit from rising prices. And typical strategies are buy and hold and active long-only strategies. So of course, spot traders can buy the asset when they expect rising prices, and they can sell the asset when they expect falling prices. And typically, spot trading is not really restricted by regulators. And now let's have a look at derivatives trading. So derivatives trader can bet on rising and falling prices because they can take long and short positions, and therefore they can actually follow active long-short trading strategies. So we will see some examples of active long-short trading strategies in this course. Now, most important, leverage increases the volatility and it amplifies the profits and losses. And therefore, high leverage also means high risk. And this is the reason why derivatives trading is restricted in many countries by the regulators. And the reason is that they want to protect retail traders. So that's a pro, actually. And in many countries, derivative trading is either completely prohibited or there exist different leverage rules and limits for different asset classes. So for example, you can take more leverage for traditional currencies like euro, US dollar than for cryptocurrencies. But this depends on the country. And finally, the question is leverage equally desirable or useful for all asset classes? And the general rule is that the more volatile the underlying asset itself, then the less desirable or useful is additional leverage. And for example, this means that if the volatility of the underlying asset is low, then a high leverage of 30 to 50 can be beneficial and also manageable for experienced traders. And let me just highlight here the two words experienced traders. And one example of an underlying with low volatility is the currency pair euro US dollar. And in contrast to that, if the volatility of the underlying asset is high and cryptos are typically highly volatile, so like Bitcoin, then no or moderate leverage, for example 2 to 5, is better than high leverage. Finally, you might ask yourself, is spot trading or derivatives trading more suitable for me? And in many countries, you don't have a choice, because in some and meanwhile many countries, derivatives trading for cryptos is prohibited, but crypto traders can still make considerable profits with spot trading because the cryptos are highly volatile. And also let me highlight one more time that derivatives trading is for experienced and skilled traders. And my clear recommendation is to start with spot trading. And if you can't make profits with spot trading, then you won't make profits with derivatives trading. And in fact, you will make huge losses with derivatives trading. And the reason for this is quite complex, but in one of my other courses on performance optimization and risk management for trading, I demonstrate that high leverage amplifies losses more than it amplifies profits. And this means that a strategy that is profitable without leverage or with low leverage is not necessarily profitable with high leverage. And that's definitely a surprising finding. And the vast majority of traders, at least retail traders or beginners, misunderstand leverage and the impact of leverage, and consequently they just use it wrong. So to sum up, crypto spot trading is a great start into the trading business, and it allows you to become a skilled and a more experienced trader, and still you can make nice profits with the spot trading. And with this we have reached the end of this video. Thanks for watching, and see you in the next one. Bye.